Welcome to Talk Tickers. Today, we are breaking down the absolutely stellar Q3 earnings report from Ross Stores. On November 20th, they dropped numbers that didn't just beat Wall Street, they pretty much sent a shockwave through the entire retail landscape. So, let's get right into it.
First things first, what did the market think? Well, the reaction was immediate and it was loud. The stock surged a massive 8.4% the day after the report. So, what on earth fueled a rally like that?
The answer, my friends, is simple. This wasn't just a good quarter. Ross Stores delivered a performance that didn't just beat expectations, it completely blew them out of the water.
I mean, just look at the scale of this beat. Earnings per share came in at $1.58. That's a whopping 16 cents above what analysts were looking for. And get this, that's after absorbing a 5-cent hit from tariffs. On the top line, revenue crushed it, coming in almost $200 million ahead of schedule. You know, in the world of retail, that is a massive outperformance. Okay, so those are the big headline numbers. But how did they pull it off? Let's peel back the layers a bit and really deconstruct what drove this incredible beat. All right, if you follow retail, you know this is the metric that matters most, comparable store sales. Wall Street was penciling in a pretty solid 3.5% growth. Ross came in and delivered a stunning 7%. They literally doubled expectations. And management said this was the perfect combo platter. More people walking into the stores and those people walking out with bigger baskets. That right there is the retailer's dream scenario. But here's the thing. This wasn't just empty revenue growth. The profitability story here is just as impressive. Operating margin came in at 11.6%, a full percentage point higher than consensus. And cash flow? It was an absolute gusher, with the margin almost doubling from a year ago. So what are they doing with all that cash? Exactly what you want to see, buying back their own stock and opening up new stores. I mean, this is the textbook definition of a financially healthy, well-oiled machine. So what's the secret sauce? How exactly did management orchestrate this? Well, on their earnings call, they laid out a really clear playbook that is just firing on all cylinders right now. It all starts with their core branded strategy. The CEO, Jim Conroy, said his team has been laser-focused on getting high-quality, recognizable brands onto the shelves at prices shoppers can't resist. And here's what's really interesting. He specifically called out how this strategy is working wonders in reinvigorating their ladies' apparel business, a huge and crucial category for them. And you can see how this creates this incredible positive feedback loop, right? It's like a flywheel. You get better, more desirable brands. You back that out with new marketing to get the word out. That brings in more shoppers. And because they're running such a tight ship operationally, all that extra traffic and sales flows right down to the bottom line. Each piece just makes the next piece stronger. Now, a fantastic quarter is one thing, but as investors, we're always asking, that's great, but what have you done for me lately? And what are you going to do for me next? Well, management sent a very, very clear signal of confidence heading into the all-important holiday season. They raised their forecast, and not by a little bit. They raised it across the board. They took their Q4 comp sales guidance up a full point. And look at the full-year earnings per share. A huge boost to a new range of $6.38 to $6.46. This isn't just tweaking the numbers. This is management telling the market they have real conviction that this momentum is going to continue. And here's something that might seem kind of small, but for Wall Street, this is a really big deal. Management basically took a major uncertainty off the table. Those tariff costs that were a headwind last quarter, they now expect them to be negligible for Q4. For investors, that creates a much clearer picture of the company's true earnings power. So that brings us to the big question. After the stock has already popped more than 8%, what's our take? What's the trade from here? This is the key debate every investor is having right now, right? Was this a one-time thing? Can they possibly keep up this incredible performance? Or is all the good news now fully priced into the stock? So the bull case is pretty straightforward. Consumers want value, and that's a long-term trend. Plus, management strategy is clearly working and has more room to run. On the flip side, the bears are saying, hold on a minute. The valuation isn't exactly cheap anymore. Trying to sustain 7% comps is incredibly difficult, and a lot of people are already in this trade. The stock is now priced for perfection. So where do we land on this? Our view is that this quarter wasn't a fluke. We believe it confirms that powerful, self-reinforcing flywheel we talked about. Our thesis is that this cycle is just getting started. The driver here is that strong sales are turning directly into even stronger profit growth. As they keep stealing market share, we think the company's performance absolutely warrants a higher premium valuation from the market. So, based on this analysis,
we are initiating our rating at outperform.
We see a clear path for the stock to reach that $195 to $200 range. And we're not alone here. We're seeing similar price targets from major firms like BofA and Evercore. The bottom line is this. We believe the market is starting to re-rate this story, to see Ross not just as a good retailer, but as a durable, long-term compounder for your portfolio.
And as always, this is not financial advice.